So today we'll talk about a pharma microcap stock that is seriously on my watch list as a strong buy candidate. I will give you a brief overview of this company, and in the end I will explain why I believe this stock could offer an upside of more than 100%. Really. Now, before we begin, as always, nothing in this video is investment advice, okay? And with that, let's start. You see, every time I tell someone that I'm thinking about investing in the pharmaceutical industry, they always reply, "Be careful. You can make a lot of money, but it's very risky." After all, these companies spend millions and millions of dollars trying to develop a drug from scratch, and many times they fail. And yeah, that's true. However, there are many different types of businesses within the pharmaceutical industry itself. You have companies that invest heavily in research and development, but you also have companies with a more asset-light profile that, for instance, buy already approved drugs and focus on developing them commercially. And that's exactly what today's company does. Today's company operates as a specialty pharma company, buying approved drugs and scaling them commercially. It is focused on specific market niches such as hematology, oncology, and rheumatology, boasting a well-diversified portfolio with 5 core products. And I said 5 products instead of the 7 listed here because these first 2 drugs are actually the same molecule. The only difference is that one is sold in the US and the other in Canada. And the same thing goes for these last 2 drugs as well. And by the way, 63% of this company's revenue comes from the US, with the rest coming from Canada. Now, why did I get interested in this stock? Well, first because it has a good business model. I mean, this company essentially buys de-risked assets and uses its already established commercial infrastructure to scale the product without major investments. And second, I also got interested in this company because it is trading at very low multiples in my opinion. I mean, according to my calculations, this stock is trading at an enterprise value to sales multiple of only 0.8 times. That's a very low multiple. What's interesting, however, is that despite the low valuation, this company is actually delivering very strong numbers. For instance, over the past 12 months, they posted a gross margin of 63%. Additionally, they are also showing operating profits, although they are still losing money on the bottom line. Now, regarding leverage, as we see here, the company has about 14 million Canadian in net debt on its balance sheet. However, that's far from being a problem, since over the past 12 months, they delivered 24 million Canadian in operating cash flow. In other words, their debt could be easily paid off, actually in less than 1 year of cash generation. So to me, it looks there's a clear mismatch, a clear asymmetry between price and value here. I mean, in my opinion, an enterprise value to sales multiple of 0.8 times is too low for a company like this. But okay, before we discuss why this company is trading at such low valuation levels, let's now review its name. So after all, what's this company's name? So today's stock is called Medexus Pharmaceuticals, and it is listed on the TSX in Canada, ticker MDP, and also in the US, ticker MEDXF. And why is Medexus trading at such low multiples? Well, in my opinion, that's happening mainly for 2 reasons. First, Medexus Pharmaceuticals is a microcap company, and microcaps are usually simply left aside, ignored by the market. In fact, today we are seeing very low multiples across the entire microcap space. However, we have company-specific reasons as well. Now, what do I mean by that? Well, if you look at this image, you will see that Medexus' revenue has been declining, going from $113 million in 2024 to $108 million in 2025. And if you look at the trailing 12 months, the picture looks even worse, with revenues falling to $100 million. Now, why did that happen? Well, first because Rupall, one of Medexus' flagship drugs, lost its exclusivity in early 2025. And well, with competitors entering the market, Rupall's revenue started to be eroded, which pushed Medexus' overall revenue down. On top of that, Medexus also stopped commercializing a drug called Gleolan in the US in March 2025, which also contributed to the drop in overall revenue. So that's why Medexus is trading at such low multiples, because investors are seeing revenue going down and think the ship is sinking. However, that's far from being the case. Now, why do I say that? Because Medexus Pharmaceuticals has a new flagship drug that they're starting to commercialize, which could more than cover the revenue gaps left by those 2 drugs we just talked about, Rupall and Gleolan. This new medication is called Grafapex, and Medexus will have a 7-year period of exclusivity to commercialize this product in the US. Now, as we can see here, the company expects this drug to generate 100 million in revenue within the next 5 years. And I believe they're talking about US dollars here. Additionally, another key factor to understand the Medexus thesis is that this new drug, Grafapex, has very high margins. As they show us on the slide here, Grafapex has a gross margin of around 80%, compared to an average of 56 to 59% for the other drugs. Okay, so what? Well, this is important because it means that as Grafapex grows, Medexus' overall margins should expand. That's why I think this company will generate much more cash in the future than it does today. Okay, but who says Grafapex is going to be successful? Well, honestly, nobody. And realistically, the launch of Grafapex could fail. However, the company has already launched the same drug in Canada, and the results have been very positive, as we can see here on the slide, with sales going 70% up from 2024 to 2025. But okay, now with all this information, how should we think about Medexus pharmaceutical stock? I mean, is it cheap? Is it expensive? Could it be an interesting investment? How far could this stock go? Well, that's exactly what we're going to talk about now. So here's my opinion. I think this stock is cheap. And I say that because of the multiples it is trading at. I mean, as we've seen, Medexus is trading at an enterprise value to sales multiple of only 0.8 times. And using free cash flow as a basis, Medexus is trading at an enterprise value to free cash flow multiple of just 4.5 times, which is also a very low multiple. And I think Medexus numbers will only get better over time as Grafapex scales. So honestly, I'm almost buying this stock at the market at the current levels. So yeah, I think this stock is cheap. Now, could it be a good investment? What's the potential upside here? So here's how I think about it. First, do you think it would be too crazy to see Medexus delivering 200 million Canadian in revenue over the next 5 years? Well, I believe that could happen. I mean, as we can see here, the company is already showing 136 million Canadian in revenues, right? If Grafapex delivers 70 million Canadian over the next 5 years, well then, we would already get there. And let's recall that the company expects to see Grafapex delivering 100 million USD in revenue. So yeah, 70 million Canadian is definitely something achievable, in my opinion. Now, if Medexus reached 200 million Canadian in revenue and traded at an enterprise value to sales multiple of 1.5 times, that means that this company's enterprise value should get to 300 million Canadian. Now, considering their net debt, that means that Medexus' market cap would need to be at around 285 million. So, from the current market cap of 93 million to 285, well, that represents an upside of about 205%. So, Medexus stock in that case would go from the current 2.89 to around 8.81. Not bad, right? Now, here you could say that Medexus will not reach 200 million Canadian in revenue. You could argue that's very optimistic. And well, that's fair. So, with that in mind, let's now think about Medexus valuation using more conservative numbers, okay? So instead of 200 million Canadian in total revenues, let's consider 150 million. So, where would the stock go if Medexus delivered 150 million Canadian in total revenue and traded at the same enterprise value to sales multiple of 1.5 times? Well, according to my calculations, Medexus stock in that case would need to go to about $6.36, and we are talking here about Canadian dollars, okay? Which would represent an upside of about 120% from the current levels. So that's how I think about Medexus stock. Now, to wrap up this video, here's a quick summary of my opinion on Medexus as an investment. So, the company has a good business model, a decent insider ownership at 8%. They also have a strong gross margin, which should expand over time, along with the other margins, as Grafapex continues to grow. Additionally, the company generates a solid amount of cash for its size and doesn't carry much debt. And finally, Medexus is trading at very low valuation multiples, which leaves plenty of room for the stock to appreciate. So in short, that's why Medexus Pharmaceuticals stands as a strong buy candidate on my watch list. That's it for today, and see you next time.